You walk into a bank and deposit $1,000. The teller smiles, your account updates, the money is yours. Except it isn't. Not really. Because the moment you leave, that bank is already doing something with your money that would probably keep you up at night if you fully understood it. And the wildest part? It's completely legal, expected even, required by the entire architecture of how modern economies function. So let's talk about what actually happens to your money the second it enters the banking system. Most people think of a bank as a vault. You put money in, they keep it safe, maybe they pay you a tiny bit of interest for the privilege of holding it. When you need it back, you withdraw it. Simple. Except banks aren't vaults. They're not even close. They're more like financial factories that take your deposit as raw material and spin it into something else entirely. Something bigger, something riskier, something that only works if you never ask for all of it back at once. And this isn't a secret conspiracy. This is banking. Here's the thing nobody tells you when you open your first checking account. When you deposit money, you're not storing it, you're lending it. The bank doesn't put your $1,000 in a drawer with your name on it. It takes that money and immediately begins using it to make more money. They pay you maybe 1% interest if you're lucky. Then they turn around and lend that same money out at 5, 6, 7%. The difference is their profit. That part makes sense. That part feels fair, even. But it goes deeper than that, because the bank doesn't just lend out your $1,000. They lend out way more than they actually have. And this is where it starts to get strange. Let's say you deposit that $1,000. The bank is required by law to keep a small fraction of it in reserve. For a long time, that number was 10%. So they'd keep $100 and lend out $900. But here's where it gets recursive. That $900 gets deposited into another account, maybe at another bank, maybe the same one. Now that becomes a new deposit. The bank keeps 10% of the $900, that's $90, and lends out $810. That $810 gets deposited again. The cycle repeats. By the time this process plays out across the entire banking system, your original $1,000 has turned into nearly $10,000 in total loans. The technical term is the money multiplier effect. The simpler term is your money has been cloned, not copied, cloned. It exists in multiple places at once as different forms of debt and credit, all balancing on the assumption that not everyone will want their money back at the same time. And for the most part, that assumption holds. For the most part. Let's zoom out and look at the scale. As of right now, there's about $2 trillion in actual physical cash circulating in the U.S. economy, bills and coins, stuff you can touch. But the total amount of money that exists in checking accounts, savings accounts, and other liquid deposits, over $18 trillion. Read that again. $2 trillion in actual cash, $18 trillion in accounts. So where's the other $16 trillion? It's been created, manufactured through lending. It's real in the sense that you can spend it, transfer it, invest it, but it's not real in the sense that if every person and every business tried to withdraw their deposits in cash tomorrow, the entire system would collapse in hours. There isn't enough physical money to cover it. There never was. This isn't a flaw. It's the design. Now, banks will tell you this is fine because of something called fractional reserve banking. It's a term that sounds technical and boring, which is probably intentional, because what it actually describes is borderline surreal. It means banks are allowed to operate with only a fraction of the deposits they're supposed to have. That fraction used to be 10%. But in March 2020, the Federal Reserve dropped the reserve requirement to zero. Zero. That means technically, a bank could lend out everything. They don't because they still need liquidity to function day to day, but the regulatory floor disappeared, and most people didn't even notice. Here's the irony. You're told to save money, build an emergency fund, keep 6 months of expenses in the bank, be responsible. And that's good advice. But the entire banking system is built on the opposite principle. It's built on the idea that your emergency fund will sit there, doing nothing, while the bank uses it to take risks. They're counting on you not needing it all at once. They're counting on you behaving predictably. And when people stop behaving predictably, things get messy fast. In 1930, a small bank in Tennessee failed. Rumors spread. Panic followed. People in other states started lining up at their own banks demanding their deposits in cash. It didn't matter that their banks were healthy. Fear is contagious. Within weeks, hundreds of banks collapsed, not because they were broke, but because they couldn't convert all their loans back into cash fast enough to meet the demand. The money was real on paper. It just wasn't there. The Great Depression got worse because of this, and the lesson wasn't that fractional reserve banking is dangerous. The lesson, apparently, was that we needed a better way to manage the panic. So they created the FDIC, the Federal Deposit Insurance Corporation. Now your deposits are insured up to $250,000. If your bank fails, the government makes you whole. Problem solved. Except the FDIC doesn't have enough money to cover all insured deposits either. Not even close. They have about 1% of total insured deposits in their fund, which is fine as long as only a few banks fail at a time. But if there's ever a systemic collapse, if a dozen major banks go under simultaneously, the FDIC would need a bailout from the government to honor its promises, which means your deposit insurance is ultimately backed by taxpayers, which is to say, it's backed by you. Now let's add another layer. Because it's not just your deposits being multiplied, it's also what banks do with the money they lend out. They don't just give out mortgages and car loans anymore. They bundle those loans together, slice them into pieces, and sell them to investors as securities. Those securities get traded, leveraged, and used as collateral for even more borrowing. Your mortgage isn't just a mortgage. It's part of a financial instrument that might be owned by a pension fund in Norway or a hedge fund in Singapore. And that instrument might be leveraged 4 or 5 times over. So the risk of your single loan is now distributed and amplified across the global financial system. This is efficient. This is modern. This is also how 2008 happened. The story we're told about banks is that they're conservative institutions, pillars of stability. Boring, even. And on the surface, they look that way. Marble lobbies, polite tellers, free pens. But underneath, they're running on a model that would make a casino blush. They're taking your money, multiplying it, lending it out at ratios that seem impossible, and betting that everyone won't panic at the same time. And it works. Most of the time, it works beautifully. Credit flows, businesses grow, people buy homes, the economy expands. But the whole system is balanced on a psychological trick: collective confidence. The moment that confidence cracks, the math stops adding up. Here's what makes this even stranger. Banks aren't just using your deposits to make loans. They're also required to hold certain assets to satisfy regulatory requirements. And a lot of those assets are government bonds, which means they take your money, lend most of it out, and use the rest to buy debt issued by the government. The same government that backs your deposits, the same government that bailed out the banks in 2008. It's a closed loop. The banks fund the government backs the banks, and your money is the fuel that keeps the loop running. None of this is hidden, it's just not explained. In early 2023, Silicon Valley Bank collapsed. It was the second largest bank failure in U.S. history. The reason? They'd invested heavily in long-term government bonds, safe assets, but when interest rates rose, the value of those bonds dropped. Suddenly, they didn't have enough liquid cash to cover withdrawals. Depositors panicked. The bank failed in under 48 hours. Here's the uncomfortable part. Silicon Valley Bank wasn't doing anything unusual. They were following the standard playbook, and they still collapsed. 2 other banks failed that same month. The government stepped in, guaranteed all deposits even above the $250,000 limit, and prevented a wider panic. It worked, but it also set a precedent. It told the market that if you're big enough or if enough people are scared enough, the rules will bend. So, what does a bank actually do with your money? It lends it, it multiplies it, it invests it, it uses it as collateral, it transforms it into credit, which becomes someone else's deposit, which gets lent again. Your $1,000 becomes 10,000 in the system, but only as long as everyone pretends that all 10,000 exists at once. And here's the part that should bother you. This isn't a system designed for you to win. It's designed for the system to keep running. Your interest rate stays low, their profit margins stay high, and when things go wrong, the losses get socialized while the gains stay private. You're not the customer. You're the product. Your deposit is the raw material, and the output is a financial system that grows larger and more complex every year, held together